Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parker-Monic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor or call your broker. That's what they're there for. There's the disclaimer.
Excellent.
I'm going to share my screen. While I'm doing that, if you guys are joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it and he will read it back to me. And to give you guys a couple minutes to put those questions in, we'll start out taking a look at the pre-market report, see if we could get insights, what's going on in the pre-market trading, and then we'll move on to the questions. So let's start out with the pre-market report over here. And these are stocks trading in the pre-market hours. Up top here, we have a calendar view, which you can use to click on and go back to a historical date if you wish to see what happened in a pre-market hours on that date. So far today, January 11th, this is what's going on from high level. We have 511 stocks trading higher in the pre-market hours, 339 stocks trading lower. As far as volume goes, we got 129 million shares trading on up volume versus 47 million trading on down volume. And if we convert that volume to dollar value, we have $3.4 billion worth of stock trading higher in the pre-market hours and $2.9 billion worth of stock trading lower. And from that perspective, it looks like the trading in the pre-market hours so far has a bullish lean or some bullish sentiment. Let's scroll down and look at it from a couple more perspectives. If we come down here, now we see a list with stocks or symbols of stocks that are trading in the pre-market hours. So we see the symbols, the price changes, the volume, and we have a most active stock list, biggest percentage gainers, and the biggest percentage decliners. So here I see 72 stocks made our biggest percentage gainers list, 35 on our biggest percentage decliners list. And to make this list, we do set certain thresholds the stock has to meet besides the price movement. We look at liquidity measures, volume, and price and all that to make this list, because things in the pre-market tend to be very illiquid. And as you could see, there are stocks in there, even if they meet our thresholds. There are small cap stocks in there, ETFs. There could be closed-end funds. It could be a leverage product. Could be an inverse product or preferred stock. So any security, if it is listed on the major U.S. exchange and it's trading in the pre-market hours and meets our thresholds, it could make this list. So to narrow down this list to a smaller group of stocks, we could use the filters above. I always say if you do have a watch list and you're curious just to know what's moving in your watch list, or if anything in your watch list makes it on this list, you can filter by your watch list. In our example, we're going to use the filter next to it, one that says in ETF. We click on it, we get a drop-down menu to select from, and we're going to choose SPY, which is the S&P 500 ETF. And when we do that, the list below will get filtered by stocks that are holdings in the SPY. So to make this list now, it has to meet our thresholds and be a holding in SPY ETF, which are the S&P 500 constituents. And we could see here that for the biggest percentage gainers list, biggest percentage decliners, again, has to meet those thresholds. We got 3 that made our biggest percentage gainers. Well, only 1 on the decliners. Not a big list, but slightly an indication that the trading in the pre-market hours seems to be leaning towards the bullish side, or bullish sentiment. Right, so we gave it a couple minutes. I'll take those questions if you have them.
No questions have popped up yet, D.
Okay. I'll just default to SPY while we wait for questions to appear. This is my kind of just main default symbol. And just from memory, I'm trying to recall questions that I get over the emails or chats or comments. While we don't have any live questions, and one of them was looking at the performance of the straddle, and how does the option straddle, if we look at the near term month, and we want to know, well, typically how does the straddle perform from one day to the next, right? We're just curious. So let's say today is Thursday, right? And if we look at an SPY straddle at some point today, and if we held it till Friday, right, from the long or short side, right, you could buy a straddle, you could sell a straddle, and if that was the trade you wanted to analyze, right, one question could be, well, how does that straddle perform? Like if you just did it over and over, obviously there's not going to be always a winner. It's not going to be always a loser because the markets are changing. But if we wanted to look at history and see how those premiums were priced on Thursday, right? Because when you're doing a straddle, what are you doing? You're let's take a look at this. So tomorrow, right? If we're looking at it today, at a straddle that will expire tomorrow at the end of the day, so we would be looking at this straddle, where let's say 476. We would be looking at some point today. Right now, we're not open. This is yesterday's. This would be the straddle. If we just bought it, right, you're paying a premium for it. And if you did that, bought it or sold it, right, let's say we just bought it and we just held it till the end of the expiration, didn't do anything else, right? That was it. How often, and the straddle could be anything. If the stock price closes at 476, then the whole straddle, right, the premium will just collapse, decay, right? Because at expiration, both of these options could be worthless if it's right up at the strike, or if the stock moves in either direction by more, in this case, this $3.29. That's the break even. If it goes beyond that, it'll be profitable. And of course, from the short side, you want it to move less. But the question is, well, how often does the stock move, right, enough to cover the cost of that straddle, whatever the market was, right? So it's just whatever the market is. We don't know. Sometimes it could be higher, sometimes it could be lower, but does the market tend to overprice it or underprice it? That's the question. Does the market, with market prices, does it tend to overprice the moves or underprice the moves if we just look at the option straddle. So let's just look at Thursday to Friday, right? Since today's Thursday, and we're going to look at tomorrow's from today till tomorrow. So I'm going to go over here under tools, and we're going to pick this one, at the money straddle. Okay. So here we have a report here, and here's some insights, but this is the way this report is set up. It looks at, first of all, it goes back in time, week to week. So these are looking at from during a week, different holding periods. You could have Monday to Tuesday, right? You could have Monday to Wednesday, Monday to Thursday, Monday, just start out Monday and hold it to Friday, right? Or you could start out Tuesday, hold it till Wednesday, Tuesday to Thursday. So all these different time frames to look at, just to see if there are differences or if something stands out. So today we're going to look at this one from Thursday to Friday, right? Today's Thursday. So what we're interested in is from Thursday to Friday, which is a 1-day hold, right? We hold it over overnight for 1 extra day. So it's not same day, it's not same day expiration, there's an extra day. And what we're curious at this point is, okay, if we looked at the previous weeks, the most recent previous weeks, right? Not like 2 years ago or 3 years ago, because that's a long time ago. Let's look at the most recent data. How are the markets in the most recent history, pricing this straddle? And so now we have this data going back, here we go. This was last week, right? Then, and obviously there's some blanks in here because we had some days off, or not full days, but so there has to be a full day here. But this is last week, week of January 1st, week of December 25th, week of December 18th, December 11th. So that's the data. So last week from Thursday, looking at the straddle from Thursday to Friday, that straddle, and this takes a snapshot at 10 a.m. By the way, this is in the beginning of the day, the initial snapshot. So it allows the first half hour, which is kind of more volatile, is busy. Like so let's say at 10 a.m. That's what this particular report is looking at. So from 10 a.m. on Thursday till Friday's close. Okay. What happened last week? Well, if you bought that straddle, the premium at the on Friday, one of the legs was in the money, one was out of the money, right? So what was that worth? Well, last week you would have lost 69%. So whatever the straddle price was, it lost 69% of its value by the end of the day, Friday, right? The week before that lost 44%, 26% the week before. So these here are the returns on the strat. That's what this is. So down here we have some summary stats. So out of all the observations in this particular report, 36% of them, and we're looking at this all from the long side, 36% of them ended up being profitable, right? So you bought the straddle, and if it was worth more money on Friday than you paid for it, it was profitable. That only happened 36% of the time. However, we know that straddles, right, they're not limited to the upside, right? So it's not like if you buy a straddle, you're limited to what you paid for it, but it's not limited to the upside. It could be up more than 100%. It could be up 200, 300%, right? There's no really limit to the upside. So even though there's only 36% of those were winners, what was the average return of all those straddles, right? So if we took the average of all those straddles, did the winners, even though they were less frequent, did they offset all the previous losers? Because that could happen too. You know, you could, when it hits, it could hit big. So that's the question, right? When they do hit and you get and it happens to be like that week that it was profitable, what if it was up like 500% or 1,000? That's the other question. So how did these average out? So here we see that on average they lost 1%, which is pretty close. That means that the straddles, actually the markets from Thursday to Friday so far tended to price them, that they were pretty well priced. Yeah, there was winners, there was losers, but on average it looks like they were pretty good. The median return was negative 15%. So that means that if we split up all the data with half the highs, half the lows, right in the middle, it's negative 15%. The worst return was negative 77%, which means that, okay, they're straddles, but so far out of our data, none of them lost 100% of the premium. In other words, didn't go right to the strike. There's still, a straddle could lose money, but if it's still in the money by a certain amount, right, you're not getting zero, you're still selling it for something. So the worst out of the last, since October 16th, the worst one so far was down 77%. Of course, that doesn't mean it can't lose 100%. That's just what we're seeing, down 77%. What about the best one? What was the best return? That was 108%. Okay. So these are some summary stats. Then we have the standard deviation of the returns. So you can see they're pretty volatile. What does that mean, standard deviation of these returns? Well, what we see is that the returns themselves are all over the place. It's not like, you're either making 5% or losing 5%, right? They could be all over the place. Sometimes, you're down, 69%. Other times you're down only 8%. Sometimes you're up 94% or 108% or just 20%, which means that the standard deviation, the variability, the returns could be very wide, right? There's no there, and it's because we're using options, right? So options, the returns are all over the place. So you got to keep that in mind. Sometimes your return could only, on the positive side, could be, smaller, could be very big, or to the downside, it could be small or very big. So the variability is very high, right, of these returns. It's volatile. This would be a very volatile strategy, is what that's what this is saying. The volatility of the returns. It's like, if you're invested in a stock, can you imagine, like, if you're invested in a stock and in one day you could lose 69% of the value that you invested or make 108%, right? Options are, that's how volatile the variability of those returns are very wide, right? And that's what this is saying. So then the next question is, well, on average, how much, if this is my risk, that if we measure a unit of risk could be like, it could be, the standard deviation of those returns, if that's how we measure it. And if we took the average returns, how much do we earn per unit of risk? And that's what this is. Well, right now, if the returns are negative, this is negative. So that's what the summary stats are. And now we could go into the data and see what the data actually says. Let's look at that data. So see this view details. I'm going to click on that. And now we got the data over here that, the supporting data for these calculations, for these stats. So let's take a look at that. So here we see the latest, right? We don't have this week's. This week's will end tomorrow. But last week, right, we looked at the January 5th option, right? Because the January 5th, that was last Friday's expiration. So we're looking at the January 5th. So this would be on Thursday. So on January 4th at 10 a.m., right, we're saying, okay, look at the option because that would be Thursday, January 4th, 10 a.m. Look at the option that expires Friday. So that would be the January 5th, right? And when we looked at it, right, we said, okay, this is where the stock price was, 168.91 at 10 a.m. Okay. And we could go back and look at the options chain, but this is taken from the options chain. So that's where the stock price was. So the nearest at the money strike was 169. Right? We're not going to find a strike 168.91. They don't have strikes for every penny, so we have to find the closest one to the stock price, which was 469. Okay, so the 469 strike, the call was priced at $1.75 at that time, and the put was priced at $1.75. So the straddle itself, right, would have cost $349. Right, it's $1.75 times 100. It's $1.70 plus $1.75 times 100. And what this is saying, and if we translate it to what is the percentage that the stock would have to move, in to cover that premium, that would have been 0.7%. Right? Because we could convert the dollar value to percentage. How much does the stock have to move to break even? That's where the buyer and the seller break even. That's the fair value. And then we'll say, okay, now let's see what happened. So this is what it was like at 10 a.m. So what happened on January 5th? So right before the close, like 3:59:30, we're looking at here. So right near the close, the stock was $467.93. So it didn't move that much, right? It moved 0.2%. It went from 468.91 to 467.93. Obviously, it didn't move the $3.49. It moved less than $1, almost $1. So what happened? Well, the call was worthless. Expired. It was out of the money. It was worthless. But the put was in the money, right? Because it's the 469. The put was in the money. It was worth $1.08. So you didn't lose 100%. You could still sell the put for 108. So when you sold it, you got back. It was actually 107.5. So you got back $107.50 out of the 349 you invested. 107.50 you got. You were still able to recover that part of it. Well, that results in a $241.50 loss. So in percentage terms, that's 69%, right? Because if you go from here to here, well, that's a 69% loss in value. So that's what it happened last week, and that's what we're doing, repeating it every week, week to week, and that's how we're getting these stats. Okay. Now, there there are two more methods here that we put side by side as comparison. And those are if you hedge the delta, because when you do a straddle, and this one was pretty close, this is pretty close to the strike. This one's pretty close to the strike. It's not always that close. This is 41 cents away. So these will be close. But when you do a straddle, some of it, sometimes, like you could see here, the call is worth more than the put. Why? Because the call is more in the money, right? And like here, it was exactly the same. It happened. It was very close, but it's not always, exactly, at the strike price, which means it has a little bit of delta. You might have a little bit of a lean. You might have a bullish lean. In SPY, it's close. Other stocks, it might be further apart if you have $5 strikes, right? So if you pick a strike that is close to where the closest to where the spot price of the stock is, but the call could be in the money, the put is not in the money. Well, you have this initial delta, which means you have a bias for it to go up or down, right? Because if the call is more in the money than the put, then you want the stock to go higher, right? Because if it goes lower, you're losing more money on the call than you're making up on the put initially. So to offset that delta, you could hedge it with stock, right? That extra delta, you could hedge it with the stock. And if you did that, these are the results. This is initially the delta neutral. So we could compare it and see like, okay, it looks like actually the delta neutral didn't help out at all. It was a little bit worse. Okay. The standard deviation went down a little bit, but it didn't help out at all. So another method we could look at is delta rehedging, because not only initially, okay, you have, well, actually for one day won't matter that much, right? So maybe, well, you do rehedge it one day. That even if you hedge your initial delta, by the end of the day, the stock moved. And if the stock moves by the end of the day, well, all of a sudden your call could be worth more than the put, or the put would be worth more than the call, because now it's more in the money, and that means you're taking on more. So that means you need that the next day. You need the stock to continue in that path. You can't revert, because if it reverses, then it's bad. So this says, well, what if we rehedged again at the end of the day? And that would be the result here. So actually the rehedging was worse than just letting it go. So we're right up at 9:30, Will.
We did have one quick question, D. It is 9:30. Maybe we can look, well, maybe you can show them on tomorrow. Rohit was asking, do we have an option chain history? I'm pretty sure you can go to the options chain and there's a drop down menu, but maybe you can show us that tomorrow.
Yep.
All right, we'll show you that tomorrow, Rohit. Thank you everyone for joining. Great job, Dima, as always.
All right. Thanks everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace.